It's an important print for Airbnb tonight as investors watch for how rising rates have impacted the company. That's the focus of today's Tech Check with Deirdre Bosa. Morning, Dee.
Hey, good morning, Carl. So earlier this year, speculation that the, quote, Airbnb bust is upon us. It was everywhere. You've got a housing market in limbo, higher interest rates, making it more expensive to finance a short-term rental property, lower occupancy rates in popular vacation spots, and major Airbnb markets like Phoenix and Austin. There's also return to work post-pandemic. But what was supposed to be a perfect storm to hit the business model hasn't materialized in a significant way, and the company is generating more free cash flow than ever. That's because rising interest rates help Airbnb, the company itself, even if it makes life potentially more complicated for its hosts. Now, when you book an Airbnb or a Vrbo, the company charges you at booking and holds on to that money until you arrive for your stay. It then passes it on, the due amount, to the host. But in the interim, that period between booking and stay, which can be months, the platforms have billions of dollars in customer money to invest in money market funds and short-term, high-quality bonds. Rising interest rates means that those returns are higher than ever. And that is a key part of what makes Airbnb profitable compared to, say, another sharing economy company like Uber, which can't play with that kind of arbitrage. Now, the holdings for short-term rental sites, they are huge, given that these are travel companies. These are not financial services companies. At the end of June, Airbnb held more than $9 billion in funds on behalf of customers. Expedia held $11.5 billion in traveler funds, and Booking Holding held $6 billion. Interest income has shot up over the last year. In the first half of 2022, it was just $25 million for Airbnb. In the first half of this year, it was $337 million, and management credited it for a large spike in net income. Now, to be sure, this new source of income, interest on customer funds, it's only part of total profitability, but it continues to make Airbnb an unlikely beneficiary of rising rates and can offset some of its challenges. Tonight, when it reports, the core business will be in focus. Revenue growth is expected to decelerate year over year, and there are growing cracks around the edges. Nights booked decelerated earlier this year. The average daily rate is shrinking, and there's also a new regulatory battle where you guys are in New York.
What about just general demand, Deirdre? How much is it correlated to what we're hearing and seeing from the hotels and the cruise lines and the casinos, which, I mean, the commentary has been very bullish. Caesars today saying no signs of a slowdown. We got good news from Hilton. Airbnb sort of, it did well during the pandemic when they did not, though. So I just wonder now if they're all in sync.
Right. And I guess if you look at ADR, right, average daily rate at Airbnb, people willing to pay a lot more because they wanted to book sort of whole homes, Airbnbs and vacation destinations, maybe less so cities where travel took a little longer to come back. But now you see sort of ADRs, that is the rate, nightly rates rise at places like hotels and moderate much more at Airbnb. So that's something you can look at to look at that demand. And we know that revenue growth is slowing down a little bit. So maybe a return to normal like we've seen from a lot of pandemic darlings. But Airbnb would tell you that it has been beefing up its city, its metropolis bookings that should position it well. But, you know, the CEO, Brian Chesky, has been very candid about all the things that they need to do to make their proposition compelling.